Hello, folks. Welcome to Pro Trader Strategies. This is going to be my options guide course, and we're going to be cracking the code to trading options in this course. We'll start out with simple examples and build the real life examples. By the end of all of this, folks, I think you'll have a solid understanding of what we're talking about when we are trying to figure out these options and what really makes them tick. I'm going to go through this, like I said, and we will start out with simple concepts and build to those real examples. To that end, we're going to have an example of a live trade that we could be doing right now. So without further ado, like I said, this is cracking the code. Before you go, make sure you smash the like button. Don't forget to hit the subscribe bell. That tells you when I come in and announce. These videos, I'm announced. The morning videos where I do all of the market commentary and stuff like that, spotting the trade, those morning videos are a little bit off on the timing. It's usually somewhere close to 9 o'clock Eastern, but I'll pop in just about any time there. So make sure you got that subscribed for that. All right. So let's get on with it. I need to share here. So finally starting to remember that, folks. You guys have played around with the sound a little bit. If it sounds okay, hit a Y over there in the chat window, I guess. Best way to do it. If you don't think it sounds very good or it sounds tinny or something like that, I need to play with it. Throw an N in there and say, no, I don't like it. All right. Because I can't hear what it sounds like right now. All right. So we're going to be cracking the code to trading options. This eventually, we're going to be talking about the short iron butterfly. All right. That's the ARB symbol on the floor was the iron butterfly. We're going to be talking about when, where, and why we would implement this strategy, and when it's probably not the best idea to implement this strategy, okay? So we'll go through all of that. But first off, let's start with the simple concepts of ideas. When we're talking about transferring data and streamlining that process, making it as fast and efficient as we possibly can, we are looking at what data looks like when it's being transferred. It's just O's and ones, and it's just different series and combinations of that. But it's just at the end of the day, O's and ones. So if we can make this simple, what we're going to have to do is freeze frame this, peel back the onion a little bit, and look at what's going on over there in that page with the options, where it looks like you're kind of entering a jet fighter pilot's cockpit with all these different levers and numbers moving back and forth. Once you understand those, you can see a guy flying an airplane relatively simple. As a matter of fact, sometimes he just pushes a button, right? Well, that's what I hope to do for you folks with options, is that when you get over to that page, you are not inundated with information to a point where you get analysis paralysis, or you're just constantly second guessing yourself. I'm going to get you guys hopefully to a point where when you go to that option montage page, you're immediately going to migrate to the correct strike locations that we talk about in these videos, and you'll know whether or not you'll be buying or selling that option even before you get over to that page. You're going to know what type of strategy you're going to need to implement to increase your probabilities of success. All right. So hopefully we can get this option montage page clamped down as easily as we've talked about the data transfer. All right. So folks, what's the best investment anyone can make? Bitcoin? You guys can throw it over in the chat window. We're both on YouTube and on Facebook. I know sometimes there's an issue on being able to comment sometimes, but if you have the opportunity, throw it over there. What's the best investment one could make in the market? Bitcoin? Gold? Well, most folks would say it's a house. As a matter of fact, anytime you talk to anybody that is talking investments and stuff like that, one of their best investments is usually their house. But people will just say you got to go out there and buy it low and sell high. Well, at the end of the day, it depends on where you're buying it. It feels you're always buying low with a house and selling high, at least in the last maybe 5 years or so. But when we go back and look at that, as a matter of fact, I threw this out there last week. You know, Rockefeller said the best investment was dirt because they aren't making any more of it. Well, the same thing was, I guess, disseminated by Twain and stuff like that. So it is a very broad reaching thesis there that your best investment is probably buying land or a house because it's going to increase in value because there's a finite amount of that, right? Which makes sense. Anytime we go talking about supply and demand, right? We know that if there's a limited supply of something and demand increases for it, well, that price is going to jack up. The idea about the globe being only this big, right? And we all are buying our little share of the world. Well, as populations increase, well, that probably space that we own is going to decrease, but the value of that space is probably increasing, incrementally higher. All right. So, but who's watched housing prices? Well, maybe not lately in the last week or the last month or so, but in the last several years. I mean, if I just roll back to the early aughts, or let's just go back to 2000 when we had the dot-com crash, we actually saw housing prices increasing heading into that dot-com crash. Dot-com crash happened here in 2000, right? We saw housing prices probably give up a couple of years worth of gains. Then we saw the rebound after the dot-com crisis. We got another dip, pretty decent dip, and actually probably almost came down to that level in 2000. I'm not exactly sure what housing prices were on the national average there. I know right now they are through the roof, but we did get that little bit of dip. So was this a buy? When somebody says buy low and sell high, well, in hindsight, obviously not. But, if you held it out, you probably did pretty good. We did get a little bit of a dip on COVID-19, C19 here. It wasn't much, but actually that was a 2009 crisis there. COVID-19, we just got barely a blip down. I mean, it probably, I would say, was maybe a 10% decrease in some houses across the board. So we did see a little bit of a dip. I know somebody who did very well on that dip. And then we almost got a parabolic move as of recently, right? This has to do with inflation and everything else that's going on. But we don't necessarily know right now, is this a high? I could make a claim, well, if interest rates are going to go up, I've talked about this in several other videos. If interest rates are going to go up and we have a budget, well, interest rates go up, I can still only afford, let's say, $1,000 a month for my house. If interest rates goes up, well, that $1,000 isn't all going to principal. As a matter of fact, it used to almost all go to principal, but now as interest rates rise, less is going to principal, right? And if less is going to go to principal, it's going to be harder for me to get a loan. That's going to be a more difficult row to hoe. I'm going to have to come up with more money to put down on this house, all right? Because usually when we're putting money down, it's going towards principal to lower that overall principal that we would owe, take the risk off of the bank. But when interest rates start to rise, well, the risk isn't being taken off the table so much for the banks, they think, because of the interest rates and what you have to pay in interest versus your principal. So I would say as interest rates goes up, then price is going to have to come down to compensate it. So we haven't seen into the future, but that would be what most folks are expecting. So don't want to buy there, right? No, we kind of know, at least based on this thesis, that interest rates going higher should cause housing prices to slow down. I mean, that's the whole mandate of the Fed, right? Is you raise interest rates to slow down the economy, slow down spending, and get people to be more of savers than spenders. Well, that's kind of what the Fed is trying to do here. But when folks are talking about trading and investing and everything else, what's the thesis or the theme that you hear most often? Well, it's basically you go out and you go and buy it low and you sell it high, and that's how you make money in this stuff. Well, it's easier said than done when you have markets that are moving up and back and you don't know what the future is holding out this way. You don't know if the market's going to go up or down, right? So you're constantly going out and being told to buy low and sell high, but the only thing to buy is buy now, right? And is that low or is that high? We don't often know when we're talking about things like, earbuds and, dice or whatever. It really depends on the person that wants it. This pen is worthless to 99% of, probably 99.9% of the people out there in the world. I mean, it's a pretty sharp pen. I've even got a little bit of stylus, right? But this pen won't work on a phone, won't work on a pen tab. It only works on my pen tab. All right. So this has a very small group of people that is looking for it. Now, for me, if I lost this pen, as you can see, I've done that before. I've obviously lost a pen before, so I had to go out and buy a new one. To get that pen, for me to be able to write here, I used to do my trading on this platform. When I would hit the buttons, I didn't want a mouse to try and get over there and click on it. I wanted a pen and be able to touch it and say buy, hit that confirmation. So this was extremely important to me because streamlining a process, we're talking Six Sigma or whatever, to drag it over there and find it with your pen is a little bit more difficult than grabbing this. I can move the pen quickly to different locations. Okay. I don't know if you could see that quick move, but that's what it is. So while folks are telling us that, hey, buy low, sell high, it's not that simple. It's a simple phrase to say, but in reality, because we don't know what's going forward, what's going to happen next, we don't know if we're buying low or selling high when we're buying commodities or stocks or a house for that matter, right? Physical products for the most part. But another example of a sideways market, usually sideways markets are easier for our eyes to see trends or support and resistances when they are horizontal, rather than if you had an underlying that was moving higher, right? It's usually more difficult to see unless you have a trained eye to kind of spot those lines out. It's a more of a natural feeling when you're looking at something that is trending sideways to be able to get those support and resistances drawn in. Like your eyes, when you're kind of looking at this, I mean, maybe when I'm doing the little wavy lines, it's a little bit easier because they're pretty much exact every time. But usually, even for me, is a little bit more difficult sometimes to see those support and resistances on a bullish or bearish market. But sideways moving, we can pretty easily spot that. We can see price. We know what that level is and all of that stuff because it came right back to 100. We know that that's the support and resistance or support and resistance. And if somebody told you, hey, you got to buy down here because that's low, well, that may be the IPO of an underlying. You miss that, right? You're kind of taking a look at it. How many times have you guys thought, I'm going to buy this thing, and then all of a sudden you wait a day or two and you're like, I should have bought it. It went up, right? And then you go out there and you buy it, and what happens? I buy right here, and it immediately takes a dip, right? And then you're starting to second guess yourself. Do I sell out? Do I get out of this trade? It's already gone against me. You're always constantly asking yourself those questions on whether you're buying low or selling high. It doesn't matter if it's IBM. It doesn't matter if it's Apple. You're always questioning yourself. And as a matter of fact, we can even make it more convoluted by looking at stocks and saying, hey, when I'm looking at a stock price, how do you come up with that valuation? Well, the valuation is based on their current earnings, and then it's a multiple on that based on a better economy, or that this company is going to continue to grow, right? Well, right now we've seen some bearish moves happening, right? And while we're hearing hubbub out there that the economy is doing terrible, we're watching these markets free fall. And that's because economists and investment professionals and all those folks are out there telling you, hey, the economy is not looking so good. Well, stocks come down off of those highs. Why? Not because they did bad before, but the expectations they're going to do bad going forward. So while Apple might have started out having a 20 multiple, that means 20 times their earnings is basically how we're coming up with their price for their stock. I'm trying to make this very rudimentary. Yes, there's a lot of other things that are going on in there. It's not that easy, but you get the idea, right? It's a multiple based on their earnings. And then when we say, hey, that multiple of 20 isn't going to happen. It might be a multiple of 10. Well, what happens to the stock price? It's got to go down to reflect that, right? So the price is very difficult to really come up with. Like, what is the multiple? I mean, what should the multiple be? I mean, do we go with an average? Do we go with this underlying historical? Well, all of those things are very difficult to come up with the data for one, and two, to really come up with a price, an exact price, right? So while it's easy to say buy low and sell high, what happens a lot of times is we miss that initial move and maybe miss my opportunity to sell there. Oh gosh, do I sell here? Oh, I think it's going to go back up to here. Well, what happened? Boom. Now you sell. Get out, before it really goes, to the wind. It's the only thing I can think of. But again, where do we go from here? If I were to come into the markets today and say, hey, I kind of like ABC stock, I want to buy it because I think it's bullish. Well, am I buying low or selling high? Well, I'm kind of buying it right in the middle of at least its historical, but I still don't know its value. The beauty, though, folks, is I do have a cheat for you. I can't tell you if a stock price is cheap or expensive. I can't tell you if it's bullish or bearish for the most part. I can give you my assumptions on it, on both of those things. I can tell you if it's cheap or expensive all day long. What does that mean? Absolutely nothing to you guys, right? Because that's my opinions. But what I can do is break out some facts for you that when you're trying to come up with your directional assumption, you should immediately know whether or not, in the options anyway, you should be buying those options based on your assumption or selling those options and collecting a credit or a credit spread based on those directional assumptions, okay? I'll show you how you'll immediately know whether or not you are going to be buying those options or selling those options before you even turn to that option page where it shows you the calls and the puts. We can do it from the chart. I'll show you how to do it in a little bit in a moment. But the reason why I want to trade options more often than not, they give us a tell whether or not they're cheap or expensive. So I immediately know if I should be buying them or selling them. When I'm looking at a stock, I don't know if that price is cheap or expensive. I can just kind of come up with a pretty good idea if it's going to go up or down based on the charts and stuff like that in my market analysis. So while we don't know what this pen is worth, we would know if the options around this pen were expensive or cheap, right? And that's because we have this little thing called volatility that we can chart. And more importantly, we don't want to just look at volatility or the VIX, okay? When people hear volatility, a lot of times they immediately think of the VIX, the VIX, the VIXX. No. While I do think that it is important to keep your eye on VIX, because it tells us what the broader market is feeling in regards to volatility. All right. It's a broader gauge. It's basically everything. It's the put buying and the sell buying that the put buying and the call buying that is really driving that volatility higher. All right. So when we're looking at implied volatility, when we're looking at implied volatility, or if you just hear me talking about volatility, you should assume I'm talking about implied volatility. I'm not talking about historical volatility. I'm not talking about VIX. I'm talking about implied volatility. And everything has an implied volatility pretty much, whether it's a future stock or ETF. And what it does, what implied volatility is specifically, is it's the expectation of volatility in the future. All right, that's the difference between historical volatility and implied volatility. Historical volatility is what we see this underlying volatility is today. All right, and then if tomorrow that print is lower than today, well, then it's lower. Okay, implied volatility looks forward. It looks out in time, more closer to maybe earnings or whatever. It's kind of looking out to earnings or future events. So it's this implied volatility gives us a number today, but it's based on future volatility. All right. So when we see this line going up and back, we're basing it on not only what we've seen in the past where this implied volatility is, but the expectation of volatility going forward. All right. So that's why I find it a little bit more important to do implied volatility in these next couple of steps that we're going to be building from to real life examples. You can use historical volatility. In the last couple of webinars, I've kind of forgotten to mention or talk about historical volatility very much. If you're out there, Joe, he reached out to me and said, hey, can we use historical volatility, instead of implied volatility because I don't have it on my charting system. I was like, absolutely, you can. One thing though, I believe that implied volatility is a bit of a better gauge of it. Historical volatility gets a little bit wanky, but at the end of the day, they all kind of stay within a relatively flat or horizontal trading range. That's what we see from volatility. And I'm not talking about the broader markets again. What I'm talking about is if I'm looking at implied volatility for ABC, PDQ, all right, DFG, I don't know. So ABC's implied volatility might range somewhere between, let's say, 15 and 35, where we could see DFG's always is between, 45 and 85. Okay. So when ABC is up here at around 35, implied volatility is around 35 for ABC. That means volatility is extremely high for ABC. All right. It's at the high end of the range. Whereas if DFG went down to 45, which is higher than ABC's 35, that would be extremely low for DFG. All right. So we have to compare apples to apples, meaning I have to look at ABC's implied volatility in regards to ABC's implied volatility. DFG, I got to look at DFG. I can't go and say, well, DFG is over here at 45. ABC is really high at 35. Well, this must be really high for DFG. No, it doesn't work that way. You have to compare DFG's implied volatility to DFG's implied volatility. And while it looks like that, we can go over to a real life chart of, let's call it ABC. Doesn't matter. I don't care if this is Tesla. It's not Tesla because Tesla's implied volatility low would be about right there. But we can see that this has a pretty tight range. Yeah, it breaks out every once in a while, but for the most part, whoops, that was a terrible line. That could be the worst line I've drawn in a while. I guess I erased everything. All right, let's see if I just changed the page. All right, go back to this. It didn't give me the thing. Well, let's just take a look at another one. Failure at the disco right now. All right, we move on to the next one. I've thrown some lines in here. Like I said, sometimes we get little breakouts. I'm not going to worry too much about the ones that break out, once a year. Okay. I actually like to clip as many tops as I can and about as many bottoms as I can. I don't mind it breaking out a little bit to the upside or the downside. The reason why is I just want to capture it when it's at or near its high or low. Okay. In the middle, I'm going to kind of stay away from it. But what we want to do is kind of come equal distance here between those highs and that low. And we could easily say that we're probably somewhere right around mid is right there. Okay. So what I usually say is this is the sell zone, or always say this is the sell zone and this is your buy zone, right? Because this is cheap, right? This is expensive. All right. Those are where we can tell this underlying when volatility gets up there at this level, let's call it 47. We can see that it doesn't stay up there very long. Yeah, you can get some spikes. We can't live our lives through one or two black swan events. Now, that's not a black swan event, but the pandemic was a black swan event. But 47 to 25 is basically where we're looking at for a range for, let's just call it PDQ or BDQ. All right. Anyway, so we can see that this underlying, if it gets up around 40, 45, that would be in the sell zone, because we know one of the things I didn't mention on building from simple concepts is when we're talking about this as an interest rate, yeah, it's in a decimal, but we normally see it as a percentage. What we have to remember with options is there's a couple of rules we got to remember. Yes, I said it, where there's rules we have to memorize. It's kind of like geometry where you had to memorize some rules there. But we only have to remember a couple. This one is the major one. In options, everything is assumed that there is an increase of 1. All right. So in this regard, we're talking about an increase of 1 percentage point. All right. Meaning this goes from in this 0.4 to 0.41. That's 1 percentage point when we're talking about implied volatility. Right. So all of the options will increase. Doesn't matter where they are in the option montage for that underlying. Just got to be that underlying. If it increases by 1%, all of those premiums are going to increase by the implied volatility coefficient. And we'll talk about that coefficient here in a minute. Now, some of you guys might be looking at this and saying, hey, you know, I get you, Wolfman, but volatility has been crazy now. How can I say this is, you know, the same as what it's been in the past? Well, what we do is just extend those lines out to the side, and this is the same chart, but over 3 years. All right. And we can see if we drew this line out, it's still pretty close in line. Yeah. Pre-pandemic, it might have been a little bit lower. And we will see some stocks post-pandemic have an incremental higher move. I would say that is the rarer of the case. More often than not, you're going to draw these lines out, and it's pretty much going to be in line. I mean, you can see pre-pandemic, it was pretty close to being in line with that. And I've drawn in that middle of the road midpoint there for you, right? Because we know that then that this is sell zone and buy zone, right? Yes, it does go through every once in a while a little bit, but we can see that when it gets above this half line, it doesn't stay up there very long. So you need to take advantage of it when it's there. Now, for some of you folks out there that are newer to trading, maybe split it into quarters. And then you say, okay, well, I'm going to make this my buy zone and this my sell zone. I'm going to wait for those opportunities to be closer to an extreme. I have no problem with that. I'm more of an aggressive trader. I always have to remind myself, hey, let's have some rules for folks that are not as aggressive. And this is one of those where you can easily kind of feather yourself in. Oh, this is the quarter zone. Buy down here. Sorry. I was just talking and writing. But anyway, when it gets down to these levels, you're kind of hitting it when it hits on that bottom line there. You're going to have less opportunities, but more likely than not, you're not going to feel the heat of implied volatility going against you as much. I'm willing to take a little bit of heat on that. But that's because I've been trading for a while and I've got a pretty good feel on how to turn these into my favor by using everything from volatility to all the other Greeks, which we will talk about here in a moment. All right. Wait, there was a note over there. I think I wanted to just check. No, nothing there. All right. Again, another underlying where I've stretched it out over 3 years. And we can see that this underlying, even though we've had a post-pandemic, it's reverted back to that range. You might say it's breaking out a little bit more often than it did pre-pandemic. Hey, I'm not going to split hairs. It's still the area of resistance. We see that all the time in charting anyway, where markets break through support and resistances. And that doesn't really often, send us off the rails. So this is one of those ones that is more of an incremental move higher. You can see I've gotten the old lines with the new lines kind of mixed in here. And this is NVIDIA. And the reason why NVIDIA has an increment higher is because it's correlated almost directly to one of the most volatile products out there, being Bitcoin. So now NVIDIA is beholden to whatever Bitcoin does, or these cryptocurrencies for the most part, at least the cryptocurrencies that are real. I'm not talking like Tether or any of those other ones that are stable coin or Doji coin or whatever it is, the ones that don't have any value as far as I'm concerned. Bitcoin, I can see the validity behind it. So I get that. There's a supply and demand matrix there, right? So I want to go on to today's example, though, that I'm going to be looking at. Again, I've drawn in the support and resistances for this underlying. Now, a lot of times, folks, I have in the past done mine based on basically the last 6 months. I think we're basically close to 6 months. So that's kind of where I would draw my line in the sand and use this as my data going forward. All right. That's me. Like I said, that's a little bit more of aggressive trading stance. If you are a lower risk tolerant person or have or newer to trading, draw those on the kind of the tops there. I wouldn't just hit the one top and the one bottom, because you'll never have another opportunity again, but try and clip a couple of them, maybe just slightly. So I have the script that you guys can throw into Think or Swim anyway, that will help you with this dynamic. But if we drew this out through those lines out in the past, you can see that even for this one, which is actually going to be target, is my example for today. This is target, and it's near its highs. It's actually even gone a little bit higher, I believe, the last day or two. I did this snapshot a couple of days ago because I found that opportunity. I'll talk about why a little bit more in detail once we get to the example. But I wanted to give an opportunity to have one of these play out for you a little bit, because in the past we've kind of been talking about them here. I put this one on a little bit earlier so we could talk about whether it was a good trade or a bad trade, right? Who thinks it's a good trade hit a Y, bad trade hit an N? What do you think my target trade looks like? So if I haven't beat this dead horse enough, volatility is the key component of pricing in the options, all right? The reason why I say that, a lot of people will argue with me. I get it. You can say, hey, the December options right now, or the January options right now, are a lot more expensive than these June ones that are getting ready to expire in 14 days. So how can you say that volatility drives pricing? I say that, theta or time decay drives pricing. Well, yeah, theta drives pricing down. There's no doubt about that. But what I mean by volatility drives pricing is that volatility can drive pricing up and it can drive pricing down. Theta can't do that. It can only drive pricing down. But volatility at any given moment, if that volatility, implied volatility to be more specific, increases by 1 percentage point, I just know that all of those options have just increased in price without even going over there. I know intuitively, based on the rules of options, of an increment of 1 increase, the correlated coefficients will increase those premiums. All right. I'll get to that. Don't run away just yet. Smash the like button. All right. So this is our target example. One of the things I was looking at for this one is we've broken down a little bit off of those earnings. I think it's pretty much out there. Everybody thinks that it's priced in about right. Is building up some volume here. So there's acceptance of value here. Yes, we are in a bearish market. This isn't my favorite time to put on this strategy. We're in a bearish market. I would rather see high volatility and not really have a major directional move here, because the iron butterfly is a market neutral strategy. Limited risk, but it is market neutral as well. So I expect this to trade sideways. All right. High volatility, you can see. So what do I need to do? I need to collect a credit. One of the things we know is the options at the money have the most extrinsic value, if you will, or the money we can extract, the theta. And I'll show you how we can take advantage of that guy. All right. Let's simplify this. Before we go over to that option montage page, I want to do a little bit of background here. Sorry about that. Now I come from the floor, so we talk about options sometimes a little bit differently than you'll see on mainstream media. But anyway, delta, sorry, I didn't almost spell that wrong. I almost gave it away. Delta is really a component of option pricing that fluctuates based on what the underlying does. So when we're talking about, let me see where I can write, X, Y, Z. All right. I've been using this example, so please, folks, stay with me. Throw stuff over there in the chat window to throw me off or get me off my my mark so that I read a different example on this one maybe. But delta tells us that when an underlying moves higher by $1, so if the underlying moves higher by $1, then delta, that coefficient associated to those options, meaning there's a little number there, that's the coefficient. If the XYZ increases by $1, it tells us, the rules tell us that delta will then go into the calls. Delta will come out of the puts, all right? So delta is based on an advancement, which means the calls will gain in value and the puts will lose value, right? Because a put, if you're a buyer of a put, it gives you the right, but not the obligation, meaning you can, but you don't have to sell that stock at that price, right? Well, if puts are below where the underlying is, do I want to sell XYZ down here when this one's going this way? No, or actually, I did it bad, going that way. Do I want to sell it down here when it's going that way? No, because I could sell it up here. So I would just sell it up there. Doesn't make any sense to do it. So therefore, as the market goes higher, those puts go down in value because it's less likely somebody's going to want to sell it that far below the market, right? So delta has the calls and the puts. Puts are always negative. Calls are always positive, right? Because the assumption is an advancement, all right? And so when XYZ is trading at 100, we call these calls and puts that are at the money puts. So, or at the money calls. And those usually carry a 50 delta. Now, Ron, I see, is in here because he's already commenting, but Ron brought up a great point. You know, what do you do with skew? And we talked about that a little bit in the last video. Right now, if we are looking at an underlying and we talk about probabilities, and that I'm going to talk a lot about probabilities if you ever watch any of my videos, because it's all about probabilities. And when we're trading, it doesn't matter what really you and I think. The probabilities that I buy the stock on a tick and the next ticks, all those ticks next are higher, is about 50-50. The next tick lower is 50-50. All right. So if I'm buying a stock at 100, what's my probability of the next tick being higher? 50-50, right? So when we're talking about options, those ones that are right there at the money are 50-50, right? The puts are -50, the calls are +50, right? Now, anything that's, you know, in the money, calls are below the market, meaning calls give you the right to buy the underlying, but not the obligation. If I could buy it below, yeah, there's value in that. So those options that are below where the current underlying is trading, the calls that are below carry a higher delta, right? The further away you get on those calls out of the money, higher, those are smaller, all right? Those are less than 50. Anything below is more than 50. Anything above, you know, is less than 50. And, you know, it's not always. I'm not making that finite. It's not always, like I just mentioned with Ron bringing up a great point. Sometimes there's skew. Sometimes it's bent a little bit one way or the other. And we'll show something like that here in a minute. But if we wanted to make it a perfect world, if you could, those ones that are at the 100 level are 50-50. So if this underlying increase from 100 to 101 got that $1 increase, these at the money options, that have a 50-50 delta are also going to have a price with them. So let's say that these are $2 at $2.50, and we'll just make the puts the same way, $2 at $2.50. You know, because when you go over to that option montage page, you will see price over there. All right. So when we're talking about the delta, this goes to 101. Now that increase of $1, right? The first dollar increase. Well, then delta goes into those underlyings. So if we went to 101, we would see these prices and the calls increase to $2.50 and $3, right? The puts, on the other hand, it's got a negative delta. So a positive plus a negative makes it a negative, right? So it increases by $1. This goes down to $1.50. The offer goes down to $2, right? So it decreased by 50 cents on that move, all right? But what I would rather you come away with than this remedial stuff is that on the floor, we used to call delta data because it gives you all kinds of data. One of the most important things is the probability of being in the money at expiration by 1 penny. Now, I hear this definition butchered quite often. Is some folks are like, it's your probability of being 1 penny in the money. No, it's not. It's the probability at expiration. On that day of expiration, I'm at least 1 penny in the money. I could be $500 in the money. All we're saying is your probabilities of being in the money are by 1 penny. Okay. So the ones that are below the market in the calls that have the higher delta, you know, might have an 85 delta. And I hear people, you know, teaching option education, and they like to talk about those in the money options because they got that big delta. And for every dollar move higher, yeah, you gain a lot out of it. I've got videos that show why the out of the money ones are better, but I'm not going to split that hair right now. Delta is data, the probability of being in the money by 1 penny. So you're looking at a 16 delta call. It's got a 16% probability of being in the money at expiration. Negative 16 delta in the put, it's still a 16% probability of being in the money because the market can go up and go down at any given time. And further, to make it even more important, 2 times delta equals your probability of touch, which is something that we came up with on the floor as options traders. And it was basically a given on the floor that you knew this little metric. It's really nowhere else that I've seen anyway, unless it was a floor trader. So 2 times the delta. So 2 times the delta, that's a 50 delta. What's that probability? 100? Yes. Well, think about it. If it's the at the money, it's obviously got a pretty good chance of trading the strike. You know, but a 45 delta, what's the probability of that? 2 times the touch, 90% probability that 45 delta will get touched. Now, I'm not saying it goes in the money. I'm just saying it goes up there and trades that handle, right? So that 16 delta in XYZ out here, the 16 delta might be probably the one, let's say the 135. So let's just say that's a 16 delta. That means that during the life of whatever this option is, I have a 32% probability of seeing XYZ trade 135, right? I have a 16% probability of finishing 135.01 or better, all right? So the probabilities of finishing in the money are not nearly as good as the probability of touch. And you'll probably make more money if you do it on the touch rather than waiting for the end of the day, all right, for that expiration to finish in the money. So delta, yeah, it does fluctuate the prices a little bit there. But more importantly, the probabilities of your success is what I want you to take away from this, all right? Then we have gamma. Nobody really talks about gamma unless you're a gamma trader. But what's important about gamma is it just, the easy way to remember it, goes with delta. Gamma always goes with delta. And usually those at the monies carry a coefficient of around 5 cents. It's right around a nickel. It gets a little bit smaller the further away you go from those at the monies. But gamma goes with delta on the second dollar number 2. So basically we would be looking at XYZ now trading at 102. So it's gone from 100 to 102. So now this 5 cents goes into gamma goes into gamma goes into the calls, gamma goes into the puts, right? So if gamma goes into the calls over here, now it's 55 cents. So we would see 305 at 355, right? Because the first dollar was 50. Now gamma goes with delta. Now it's 55 cents. But on the, at least for the calls. Now on the puts though, 5 cents goes into negative 50 cents. What happens? They only decrease now by 45 cents. So now we would see these be only at 105 and these would be at 155, right? Is it lowered by 45 cents only? The next tick, the puts are going to lower by less even yet. All right. Next tick higher. All right. And then we have Theta, who is the thief. The thief in the night. Remember the thief, right? He's constantly stealing from you. Constantly. He's never going to stop until those options expire. And further out in time, he really doesn't even care about you. He doesn't even know you're alive. So really, he's just kind of taking his tax from you, if you will. But the thing about Theta is it's not linear, binary. It's not constant. It is an increase of it's like a ramp. It starts out way out in time, pretty flat. And then it picks up steam and then it drops off a cliff, basically, it feels like. And this is the cliff is 7 days to expiration. Where it starts really picking up steam to the downside is right around 35 days to expiration. I talk about 45 days to expiration is kind of like your zone to get in. This is the sweet spot, but I'll push it back about 10 days. That's about as far as I'll push it back to get involved in a strategy because I don't like those 10 days of flatness. And then really we want to look at another key area, which is 70 days to expiration. Probably should start making these different colors, huh? Would it make it easier to read this if I started doing different colors of ink on the thing? Throw a Y over there if you think it would. Throw an N over there if you don't think it would. Please help me out here. I want your feedback. All right. So if Theta is not really doing much out here, right? What do you think you would want to do way out in time if he's only taking a penny out at a time? This is your buy zone. All right. Sell zone, right? We want to get these. Sorry, I'm saying right a lot. I'll try and stop that. Remove it from the vocabulary. What we want to do is try and increase our success rate. One thing we can do, take advantage of Theta. If we know Theta is going to be stealing our premiums like this, you want to sell high and buy it back low, right? And if you want to be a good steward of your capital, you don't want that guy taking fistfuls of cash. You want him when he's taking only pennies, right? So that's why we go out to the buy zone. Now, I've had arguments here and there with price of options, right? We talked about the one argument with Delta. The other one is Theta. Some people will say, well, those options that are really expensive are the ones that are way out in time. Yes, those are really expensive by just comparing them to the nearer ones because you're having to buy more time to be right? Those one options way out in time that are expensive are like, 100 days out. So you have 100 days to be right. Those options that are really cheap, well, those ones that are in, or at least they look, straight at a price and it looks cheap. Well, those are the ones that are getting ready to expire. So yeah, of course they're cheap. Theta, this thief, is getting rich off of it. So we want to take advantage of Theta in the sell zone and take limit theta as much as we can in the buy zone. And I'll show you how fast this starts ramping up, because it literally looks like, you know, a couple pennies a day, and then all of a sudden it goes bonkers. All right, so here we go. Let's get to the real life examples here. We've got our target trade, or our target idea here. Now, by looking at the chart, right, I immediately, sorry, I'm trying not to sneeze. The chart here, we immediately knew when I got over there, whatever my assumption is, I'm going to come up with my assumption here and everything else. I came up with my assumption. I think it's going to trade in a sideways pattern, be pretty close to where we currently are, right around 150. I think that's where it's going to stay. Maybe break out $5 either direction, could happen, but I think ultimately we will finish out right there at around 150. All right. So I look at this. I think I got my neutral market assumption. Next thing I want to do is kind of look at what implied volatility is doing, because this is going to tell me that I am in the sell zone. So it doesn't matter what strategy I do necessarily based on my assumption. What matters right now on this page is that when I go over there to the option montage page, I remember that they're expensive. So I need to be collecting a credit, whether it's, you know, naked strategies or defined risk strategies. Okay. You know, you need to be collecting a credit for that. 99 times out of 10. There's one example, regular butterflies get a little funky. So we're simplifying options. This, I don't know why I went back to that page. The thief in the night, we want to take advantage of the sell zone here and the buy zone further out there. The last one that we've been talking so much about is supposed to be volatility. Let me try and go back, get that writing off of there. Implied volatility, right? What is happening? Let's... I don't know if it's my finger that's touching the screen that's making my marker go crazy or not. So implied volatility is based on an increase of 1 percentage point, right? We talked about this a little bit already. And when volatility goes down, those prices go down. So I'm not going to beat this horse too much. We've kind of already got that one. But those are, implied volatility, that's what I need to tell you, is Vega. Over in the option montage, you know, they got all kinds of names, delta, gamma, theta, those Greeks. Well, they made up one for Vega and named it Vega and made it a Greek. So Vega is part of the Greeks. It's implied volatility. Theta is the thief. Delta is data. And gamma is just go with delta. All right. So let's get over to the page here again. All right. So again, looking at delta for the calls, we've got calls over here. We've got the puts over here, right? We've got our call gamma, theta, and vega. Gamma, theta, and vega. So with delta, you can see at the monies, this one's trading close to 150. So I started picking out the 150s here. What does this say about this underlying? Those are the 150s. I want you to just look at the delta, all right? Because we're gonna expand a little bit on this skew here, Ron. Is near term, the skew to me is to the downside, right? Because look, it's trading just below 150. We should be a little bit less of a delta than 50, right? If it's below, right? This one should have been a little bit more. So this tells me the skew is to the put side, meaning in the near term, folks are worried about downside in target more so than the upside in target, okay? Because they're buying puts for protection. That's what causes skew, is the buying of options, all right? Volatility is created by the buying of options. Buying of options increases volatility. Selling of options decreases volatility. So when we see skew, it is a reflection of the broader market's assumption of direction. Something I didn't mention in all those other videos. So sometimes when you guys got to sit through the boring shit, you get to the nitty gritty and it's kind of good. Hopefully, anyway. If that helps you guys out, throw a Y in the chat window for me. So this tells us that the broader markets, the broader assumption is the market is more negative than it is positive. What about 18 days? That's pretty darn neutral, right? That's got our 50-50 pretty much right there in line. Okay. So that's got no skew, right? That's telling us we're pretty evenly keeled, if you will. But then we start getting out in time, and I probably could even go further. We can see that skew to the call side is happening. So what does it say way out in time? What does it say, 2 months from now? It's saying people are a little bit more bullish. Right now, kind of sucks. But I'm more bullish further out in time. And folks, that is generally the case with trading. All right. More people are bullish than bearish all the time. As a matter of fact, to that point, I've thrown out there on Twitter and other places just trying to get feels for what people are thinking. I've always said this. If you can't short a market, if you can't take advantage of bearish moves, I don't think you're a trader. And I'm sorry. I'm sorry if I hurt somebody's feelings out there. Write me and tell me why that's not true. If you can only make money in bullish markets, that's more of an investor. All right. Long-term investor. If you only trade bullish markets and make money, if you only buy and then sell or for a bullish market, expect higher moves, then I don't think that's a trader. If you can take advantage of the ebbs and flows, that's a trader. All right. Hey, if you agree with me, throw a Y. If you disagree with me, throw an N. I'd love to take a poll here. My Twitter poll said that I was wrong. I'm still firmly a believer that those people that called themselves traders aren't making money in a bearish market right now. All right. And that's where most traders make the most money. Professional traders love bearish markets because those are the ones you get in and you don't even have to think. It's like, whoo, somebody pulls the rug out, right? So more bullish, longer term. So we're getting skewed to the long term in this target. Now, one of the things you guys remember me talking about is the sweet spot being 45 days, or not the sweet spot, but basically as far as I'm going to go out is 45 days. I'm going to stick by that on this one. Couple of reasons why. There's earnings here. They have earnings in this one. So I want to stay away from earnings on this trade. And I already discerned that I have high volatility. I want to take advantage of the iron butterfly here because I think it's a market neutral trade, or I believe in a market neutral trade here. And just thought of something I wanted to break out for you guys. Anyway, more of a market neutral trade, high volatility. I know I need a collective credit. If I collect a credit, I got a market neutral stance. One of the best ones to do is the iron butterfly. Now you could do the iron condor. That's fine. I'm going to be talking about that one next week. That's probably one of my favorite, probably is my favorite strategy of all time is the iron condor. This is one of the second favorites. Why? Because you get such a juicy credit. You don't have to be in this trade, especially if it turns into a market neutral. You get volatility coming out. You're going to turn this trade around really quickly. But 50 usually right there at the monies. Gamma, like I said, the at the monies goes with delta on that second dollar move. You can see the in the monies are a little bit less, out of the monies a little bit smaller coefficient as well. And when I'm talking about coefficient, I'm talking about these little knots, these little numbers. All right. It's the coefficient for that one, right? Sorry about, I heard myself. I caught it. Another thing I want to talk about, theta. Remember I said it was really ramping up inside of that 30 days to expiration. Look how much it goes up in the next 2 weeks. It over doubles. It actually almost 28. Yeah. almost triples, 2.5 times, probably as close to math. But outside of here, you can see that's outside that 45 days. Look at that move inside. Like we're looking at 35 days happening. 35 days, it increases by a nickel. Now, if I go from 80 days to 50 days, go further out, look at that. So outside that 70 days, remember when I was talking about that? That's the theta you would feel coming in, is 1 or 2 penny increase over this time frame, right? So I don't want to be going out there and selling those options and trying to get that big juicy premium because it's so juicy. No, I don't want to do that because it's going to take forever for me to get paid. I would rather, do a trade inside of here, have that theta really helping me out, and then go for that shorter duration trade and reallocate, churn and burn. All right. Notice delta on the put side's negative, right? Call side positive, put side I didn't mention negative. Gamma is positive on both sides. Theta is always negative. It doesn't matter if we're on the call side or the put side. You can see it's always going to be negative. It's a little less negative further out in time, nearer duration. Theta has got to take all of these premiums out before the expiration, right? Anything that has time decay in it is going to expire for 0, right? These in the money ones, they're a little bit different, folks. In the monies, they have a benefit to owning in the money options. And that is the fact that I can have the opportunity to buy a call or buy a stock below the market, being a call in the money, or selling a stock above the market, which is buying puts, right? Those will have a value because it has to be equivalent to what the underlying is currently trading. So this is 49. Basically, if this was to expire, we're talking about the 150s, right? It has basically 39 cents of extrinsic value. Actually, it doesn't have extrinsic value. Those are the puts have extrinsic value because I can sell it. Sorry. Puts have extrinsic value. Confused myself. Really good, Wolfman. 39 cents. So basically what we're saying between these two is $2.28, something like that. And take 39 cents off of this. So what is this? $2.45 is theta. So that if we were to expire today, these would only be worth like 39 cents. Okay. Because all of that theta has gone out. I have to have the benefit because I could sell it at 150 and I need to be paid for that opportunity. And then I think I got that. Everybody good so far? Do you have any questions? Throw them over there in the chat window. I will answer those as we go along. And then Vega, you can see, increases the further out in time we go. It gets bigger. That coefficient is much larger. And the reason why it's larger is because, think about it. Do you know what's going to happen in the next 4 days? Not exactly, but you have a pretty good idea, is at least compared to what we would see out here in time, right? 116 days, 120 days out, we really don't have a solid grip on what's happening. We may have a good idea. We can probably say that, the next 100 days, this war over across in Europe is still going to be going on. All of that stuff. That is probably true. But everything else, we really don't know. Are we going to still continue to be in a bearish market? No, well, we don't know those things. Now, this was one of the things I forgot to switch up a little bit because I wanted to show you how you break this straight out. And then we're going to go in a minute. I'll pull up the real platform, the live platform. Hopefully it's working. It kind of shut down on me right before I went live. But really what we want to do is, because we're looking at these at the monies, right? Anytime you're selling a straddle, this is basically a short straddle with defined risk. We're buying the wings, all right, to define that risk. So a straddle turns into an iron butterfly. So I still want you to build it out like it's a straddle and then define the risk. And what we do is we sell those at the monies. And basically, you can see $4, let's call it $5 just to make math easy. Or you're going to round. So $10, if I sold that straddle for $10, then basically what that does when I do the straddle, it gives me a price. Then I know that's how far away I go to define the risk. So I've got $10 in credit from selling those two options. That's why I'm defining the risk at 160 and 150. Now, you guys might look at that and say, those aren't equal distance away. Yeah, they are. These just that you can see this skips a little bit here. So it is equal distance away. So that $10 credit told me I need to go $10 away. By defining that risk, it does give me a little bit less of a credit, but I've defined the risk pretty solidly. So now I've created a situation where I am collecting two and risking one, right? Because the market can only go in one direction or the other. It can't go in both directions. So what I have here is I sold this put. I've got a short put spread, right? That's a put spread. And this is just a short call spread, right? So I've just defined that risk. Sold a short put spread, sold a short call spread, equal distance. But because it can only go in one direction or the other, I collected $6.64. It's $10 wide. That means I can only lose $3 and 36 cents on this trade. So I'm risking one in a sense to make two because the market can't go in both directions at the same time. So either my call spread or my put spread would lose if it really blew out. Okay. If it stays right here, these at the money options, I already explained how those have all of the extrinsic value, the theta in it, right? Because those ones that are at the money don't have any benefit, really. Maybe a benefit of a couple of pennies, right? That means what I can do my assignment risk with. So if I sold these, they have the most premiums jacked into them. All right. That will at least erode. So I can sell those. That's why I want to take advantage of high volatility. The volatility comes out. That helps me with the strategy immediately. Remember, every one downtick in volatility, these all would become negative if it downticked, right? A negative plus a positive makes it a negative. A negative plus a negative makes it a positive, right? Just a little review there for you folks. I'm here for you. So $10, make it $10 wide. Start out with that. So we want this put spread and call spread to basically expire worthless. All right. But actually, before the but, here's our breakout here. We can see that if it rallies higher, we can lose that $336 or whatever. High end, we stay right there. We finish at 150. Then I get the most bang for my buck. I'd collect all $6 and probably if it settled right there at 150, $6.64. But I'm never, ever going to wait to get out of this for basically zero. All right. I would never expect to get that. As a matter of fact, when I'm doing a strategy like this, where we have those high premiums, I'm going to look to get out here at basically 30% of max profit. And I think I forgot to mention this last week. Max profit is at $6.64. So I would try to get out of this trade when I've lost $2 on it. So basically I would try and buy it back for $4.20 or something. Okay. That would be my exit. If I can buy it back for $4.20, that would be basically your third. And I'd be happy with that. I've beaten the probabilities. And because I've gotten it with that theta decay, high volatility, if all of those things, the closer I get to expiration, folks are going to be like, there's no more volatility. You're going to take that out. Theta is going to ramp up, all of that stuff. I'll do very well with that. Now, you can notice that your break even isn't necessarily just the break even from the collection of credit, but it helps us because if it goes in one direction, then let's say, for instance, this market really rallied against me and went to 170 or something. That put spread, that short put spread is probably worth 0. All right. So with that said, I get asked all the time, would I leg out? This is one of the few strategies, this one and the Iron Condor are one of the few ones that I will leg out of. Now, I'm not going to leg out of it if it's trading right there at my short strikes, right? I would be silly to do that. But if we were to get a big breakout happening, which I didn't think I took a snapshot of that. Let's just go to today's platform. All right, let me do a couple of things. All right. Pull this over. Come on. Pull this over here. Blow it up. All right, get target on here, not Neo. All right, so target. You can see I've got this. I told you I do the last 6 months. I do the implied volatility percent, which basically is the math. It's not just doing the eyeball, drawing your support resistance. It's the math that really picks the high and the low and then where it's currently at, discerned where we are within that range. I've got the script for that. You guys can write to us and or email me and I can get that to you. But I will leg out of this one on certain occasions. Like, look at this. We've gone all the way down. If I go over to the chart, you can see that today would have probably been the day I legged out of the short call spread. So if we went back to this, I'm going to have to go to, let me close all this down so I get to, look at that. Oh, I don't want to close that one. I want more. Let's just go to all of them. And then, so back to this one. This is where I originally had sold the short butterfly, right? So did that, went to define it at the 160s, and then went to define it at the 140s. All right. So now this short put spread is garbage, right? That one hurts. But the the short put spread stinks. The short call spread, if we just look at this, that one I could get out for $1. Now remember, if I get out and leg out of this spread, I'm paying $1 to get out of this spread. That means my break evens change a little bit. Remember, I had that $6 credit originally, $6.64. Well, if I get out of this spread, really my credit is $5.60 now. All right, that's my credit, my total credit. I've got to think about that as my break even with this butterfly, because this put spread is losing money. Now, the only way I would leg out of this is if my assumption was target was going to do an about face and rip back to the upside, right? So today would be the day that I would have been probably getting out of this one. And then you can see we also got a nice little bottoming pattern here in target. I might even wait for a little confirmation to happen here. But at the end of the day, when that short strike or short call spread or put spread gets breached on the defined risk side, the one that's worthless, that other spread that's worthless, I'm probably going to cover it, especially if my assumption's still the same. If my assumption's changed and now I'm just worried about the downside, I'll probably let this trade work itself out to the end of the day. I knew my risk. I knew my reward. Yeah, you could have to worry about the closer and closer. I'm not going to actually say I said to the end of the day. I'm going to write it out quite a bit. I will get out inside of 7 days to expiration on just about every strategy I have, especially if it's losing, because I don't want that short put to come back to haunt me where I actually have to buy a pie. And yeah, I have the long put to define that risk. I don't really have to worry about it too much, but it's just the costs of going back and forth and the headache of getting assigned and the you have to pay dividends possibly and all that kind of stuff. So I'd rather just avoid that and get out around 7 days to expiration. But today would have been one of those days that I would look to cover the call spread on that big push down, breached my put spread. I would have probably tried to get out of that for as much as I could. Maybe 50 cents is where I got out. when it was right off that low. So look, increase my break even a little bit, or decrease my break even a little bit, because I bought back that one strategy for 50 cents. So now, I only have a total collection of $6.14. All right. And that's my put spread. So still pretty good risk reward, but I did take some of the reward off the table. All right. And that's hopefully because if I get this market to move back around and get closer to my 50s, then hey, that put spread is going to be golden. All right. So one of the very, very few times I would leg out, all right, is when I get a situation like that. Same thing would go for the iron condor that we'll talk about next week. I'll talk about strike locations, credits that we need to collect, how you find those strikes. Like, has anybody ever told you guys, if you can comment, please comment. Has anybody ever came to you and said, hey, when you're doing an iron butterfly, you sell the straddle first, and that price you get for that straddle's how far you go out? Because remember, when you're collecting a credit, it's a lower probability of success strategy on this one, because I'm selling those at the monies. But that's why I get to collect such a big premium. That's why my reward is so high, is because the probabilities of being right there at expiration are almost impossible. So another reason why I'm going to get out of this strategy for a little bit less profit. I'm going to try and leg out of it because I know my probabilities of success with the strategy are a little bit lower. I got a great credit for it, but only way. What was my question? No. John threw no over there. I forgot what my question was to get a no answer. So with that said, I'm going to look to try and leg out of maybe something like this or the iron condor. But that's about it, folks. Those are the only two that I will leg out of. The rest of them are mostly directional trades, right? So very difficult to leg out of a directional trade. I would say any other strategy, don't try and leg out of it, especially if you're trading a newer trader, because you will make money on some of those trades right away. The spread width. No, nobody's ever told you about the spread width. Thank you. The spread width, I don't know. I got thrown there. Anyway, so the probabilities of success with the strategy a little bit lower, high premium. So that's why I'm going to collect 30% of max profit. I'm going to pull the ripcord on it at that point, even if it's staying right here. If it's right there and boom, 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 it stayed there for, let's say, a week. I was at 30% of max profit. I'd pull the ripcord. Why? Lower probability of success. I got a huge premium, $2 credit, that a collection of $2 on a winning trade. I mean, how often do you get $2 on a winning options trade? So good risk reward there on the whole setup. And the other thing was, I keep thinking. Anyway, I'll think of it in a second. Maybe it's going to be seconds after I close out, but at the end of the day, that's the only ones I would really leg out of. All right. That's all I can think of right now. Other than, you know what? You guys, since you've stuck around so long, make sure you guys take advantage of this. Over 15 hours of content, how to trade against rising interest rates. You guys know that is a given. Interest rates are going to be rising. Also, more information on how you find your strike location. What kind of credit do you need to collect in order to put on this strategy? Iron condor, what do you think it is? How much are you guys going to collect for an iron condor? How much are you going to collect for an iron butterfly? Not very many people out there have these types of guidelines for you. Now, I don't say that you have to take my strike location, but I'll give you some pretty darn good reasons why. I like, for instance, when we're buying options, I buy out of the money call options. Yeah, that's me. I'm not the in the money guy. No. And I tell you why. That is a ridiculous way to trade long options for the most part. Only time I'm going to do that is if I'm trying to synthetically create an underlying. Otherwise, buying those out of the money options, I show you why those probabilities are better for you and you're risking much less. Your reward at the end of the day will be better as well. All right. If you're right. That's all I got for you guys. Take advantage of this. It will take you to this page. Please don't forget to subscribe with the bell. The bell tells you when I'm doing those morning market commentaries. And for those 30, 40 of you that are actually watching those, we've been nailing the numbers lately. So check it out, please. If you can't take that, take it easy. Take care, guys. Thanks for the kind words. Bye for now.